I do believe in the American dream. I believe there is such a thing as the American dream.
There's one thing you should keep in mind as you watch this video. Wall Street and the government are often one and the same because they're run by the same people. The 2008 financial crash wasn't an accident. It was a sophisticated heist executed in broad daylight by the world's most powerful bankers, economists, and politicians. The people who created toxic financial products made millions selling them, and then got paid in billions when those same products collapsed. Wait, what? This is the story exposed in Charles Ferguson's Academy Award-winning documentary, Inside Job. And today, we're breaking it down. How the crash happened, who caused it, who got rich, and why no one, not a single top executive, went to jail. Welcome to the Money Game, where we expose the dark side of money, power, and the people who play the system. Let's begin with Iceland, because what happened there shows us a clear blueprint for the global collapse that followed. For decades, Iceland was a picture of stability. Its banks were small, safe, and focused on helping local people. But in the year 2000, everything changed. The government decided to deregulate and privatize the country's 3 major banks to boost the economy. In just 7 years, those banks borrowed unbelievable amounts of money. Iceland had a $13 billion economy, but its banks racked up $100 billion in debt. That's not just risky, it's financially insane. But the bankers didn't care. They weren't using their own money. They were gambling with other people's life savings. And when the system crashed, they walked away with millions, while regular citizens lost everything. Now here's the scary part. The same thing was happening in the United States. The so-called greatest country on earth was following a very similar path. While Iceland's crisis played out quickly, America's financial system was quietly being reshaped over decades, all in the name of the American dream. To understand how we got here, we need to go back to 1933 and a law called the Glass-Steagall Act. After the Great Depression, lawmakers realized that letting banks gamble with people's savings was a disaster waiting to happen. So they built a wall between commercial banks, where regular people keep their money, and investment banks, where Wall Street made risky bets. For nearly 50 years, this system worked well. Banks were boring, and that was the whole point. But things started to change in the 1980s. Ronald Reagan came to power with a simple message. Government regulation was bad for business. Slowly, the rules began to loosen, small changes that seemed harmless at first. By the late 1990s, deregulation became unstoppable. The turning point came in 1999 when President Bill Clinton signed the repeal of Glass-Steagall. The protective wall that had kept ordinary Americans safe for decades came crashing down. Suddenly, commercial banks could gamble with depositors' money, and investment banks could swallow up savings and checking accounts to fuel risky bets. But deregulation didn't stop there. In December 2000, Congress passed the Commodity Futures Modernization Act, a law quietly written with heavy input from Wall Street lobbyists. This law effectively banned the government from regulating financial products called derivatives. So, what are derivatives? They're financial contracts that let you bet on the future value of something, like a stock, a bond, or even a mortgage. Here's a simple way to think about it. Imagine you own a house. Your neighbor doesn't, but they want to bet on whether your house will burn down. So they buy an insurance policy on it. Then they convince you to store gasoline in your basement and leave candles burning. That's what derivatives allowed Wall Street to do. But instead of your house, it was the entire housing market. And guess who helped write that law? Senator Phil Gramm, who later became vice chairman at the investment bank UBS. And this wasn't some mistake. This was the system doing exactly what it was designed to do: help Wall Street make money. Once derivatives were unleashed, Wall Street went wild. By the time President George W. Bush took office in 2001, the financial industry was raking in record profits. A small group of powerful firms, Goldman Sachs, Morgan Stanley, Lehman Brothers, Merrill Lynch, Bear Stearns, Citigroup, JP Morgan, and even insurance giant AIG, completely dominated the system. They had created what insiders called the securitization food chain. In the old days, when you got a mortgage, the bank lent you money and expected you to pay it back. If you defaulted, the bank lost money. So they had a reason to care whether you could actually afford the loan. But in the new system, called securitization, the bank sold your mortgage almost immediately to an investment firm. That firm bundled it with thousands of other loans, including car loans, credit card debt, even student loans, and packaged them into a complex product called a CDO, collateralized debt obligation. Then they sold pieces of that bundle to investors around the world. Now, when you paid your mortgage, the money didn't go to your bank. It went to global investors. The banks made their money upfront in fees. They didn't care if you could repay the loan because by the time you defaulted, the risk was already someone else's problem. But investors needed to believe these CDOs were safe, so the banks turned to credit rating agencies, Moody's, Standard & Poor's, and Fitch. These companies were supposed to be independent watchdogs. Instead, they were lapdogs. Why? Because they were being paid by the very banks whose products they were rating. So the game was simple. Stamp these risky products with AAA ratings, the same rating as US government bonds, and collect the checks. Pension funds, retirement accounts, and conservative investors, who are legally only allowed to buy safe assets, got tricked into buying some of the riskiest investments on earth. The entire system was corrupted. Lenders didn't care if borrowers could repay, they already sold the loans. Investment banks didn't care. They made money just by selling more CDOs. Rating agencies didn't care. They were paid to lie and faced no consequences when it all went wrong. This opened the floodgates for subprime loans, mortgages given to people with poor credit and little chance of paying them back. But thanks to the rating agencies, these subprime loans were repackaged and sold as AAA-rated investments. In 2000, there were only a few AAA-rated mortgage securities. By 2006, there were over 4,000. Did the world suddenly become safer? Of course not. The rating agencies were just rubber stamping whatever Wall Street wanted. Even Jerome Fons, a former managing director at Moody's, admitted that agencies were under enormous pressure to keep handing out high ratings, or risk losing business. If one agency refused, banks would just shop around until they found one that played ball. And the biggest banks? They weren't just selling toxic investments. They were secretly betting against them at the same time. Take Goldman Sachs. In just the first half of 2006, they sold over $3 billion worth of CDOs to their clients, including pension funds and insurance companies. At the same time, Goldman was quietly placing bets that those same investments would fail. It's like a car dealer selling you a car, and then secretly buying insurance that it breaks down before you get home. And guess who was CEO of Goldman Sachs during this time? Henry Paulson, the highest paid CEO on Wall Street. Later that same year, President Bush nominated him to become US Treasury Secretary, in charge of the entire financial system. So where were the regulators during all of this? Many of them were in bed with Wall Street, sometimes literally. Alan Greenspan, who ran the Federal Reserve for nearly 20 years, refused to regulate these risky financial products. He believed that markets could police themselves. He was wrong. Meanwhile, a massive ticking time bomb was hiding in the financial system. AIG, the world's largest insurance company. AIG was selling a product called credit default swaps. These were like insurance for investors who owned CDOs. If the CDOs failed, AIG would pay the losses. But here's the catch. Anyone could buy these swaps, even if they didn't own the investment. It was like letting dozens of people buy fire insurance on a house they don't own. If the house burns down, everyone gets paid. That meant billions in potential losses. Goldman Sachs took full advantage. They bought over $22 billion in credit default swaps from AIG, essentially betting against mortgage investments they didn't even own. Then they realized, wait, if AIG goes bankrupt, we might not get paid. So they spent another $150 million on insurance to protect themselves in case AIG collapsed. And because credit default swaps weren't regulated, AIG wasn't required to keep enough money in reserve. Instead, they paid out huge bonuses to executives the moment deals were signed, not when they actually worked. By the time the housing market crashed, AIG had taken on $500 billion in these toxic bets. And when things went south, AIG was in deep trouble. And so was the entire global financial system. By 2008, millions of Americans could no longer afford their mortgage payments. Foreclosures surged, and the entire system, the one connecting lenders, banks, and investors, collapsed. They called it the securitization food chain, and it broke. The CDO market crashed. Investment banks were left holding billions in worthless loans and toxic real estate they couldn't sell. In March 2008, Bear Stearns ran out of cash and collapsed. It was sold to JP Morgan for just $2 a share, a company that once traded at $170. On September 7th, Henry Paulson announced a federal takeover of Fannie Mae and Freddie Mac, two giant lenders teetering on the edge of collapse. Just days later, Lehman Brothers was in big trouble. They had more bad mortgage investments than actual assets. That meant they were basically broke. The entire banking system was in danger of collapsing. And Lehman wasn't alone. Merrill Lynch was also about to fail, so it quickly got sold to Bank of America to avoid disaster. Barclays wanted to buy Lehman Brothers, but the UK government said, only if the US government guarantees the deal. Treasury Secretary Paulson refused. So on September 15th, Lehman Brothers filed for bankruptcy. This caused panic all over the world. Banks stopped lending. Even the market that businesses use to borrow short-term money to pay salaries and bills completely froze. That same week, AIG owed $13 billion on credit default swaps, and it couldn't pay. On September 17th, the US government took over AIG to prevent a full collapse. The very next day, Paulson and Fed Chair Ben Bernanke went to Congress, asking for $700 billion to bail out the banks. They warned, without it, the entire financial system could collapse. AIG was one of the world's largest insurance companies. It held the retirement funds, pensions, and insurance policies of millions of Americans. So when AIG was on the verge of collapse, the government stepped in. But the bailout wasn't just about saving AIG, it was about saving the banks. When AIG was bailed out with taxpayer money, it owed billions to big banks due to risky bets called credit default swaps. In total, AIG paid $61 billion to these banks, including $14 billion to Goldman Sachs alone. In a normal crisis, companies in trouble might negotiate to pay back less than what they owe, a discount since they can't afford to pay it all. But this time, US officials told AIG to pay 100%. No negotiations. That's right. The full amount. Taxpayers picked up the tab. The total AIG bailout eventually cost over $150 billion. Why was no one held accountable? Because the people running the government had come straight from Wall Street. They protected their former firms, not the public. AIG was even banned from suing banks like Goldman Sachs for fraud, even though those banks had sold them the toxic assets in the first place, and then bet against them. It was a rigged game, and Wall Street wrote the rules. This raised serious concerns, especially since Henry Paulson, who led the bailout, was the former CEO of Goldman Sachs. On October 4, 2008, President Bush signed the $700 billion bailout bill through the Troubled Asset Relief Program, and trillions more were quietly funneled through the Federal Reserve. In total, over $23 trillion was committed to save the system. Meanwhile, everyday Americans lost their homes, jobs, and life savings. But on Wall Street, it was business as usual, and better than ever. In 2009, Goldman Sachs paid $16.2 billion in bonuses, including $68.5 million to its CEO. JP Morgan, Citigroup, and Bank of America followed suit. Their excuse? They needed to retain talent, the same talent that wrecked the global economy. Despite overwhelming evidence of fraud and recklessness, not a single top executive went to jail. In contrast to the 1980s savings and loan crisis, where over 1,000 bankers were prosecuted, the 2008 crash led to a few fines, quietly paid with no real accountability. Worse still, many of the same people responsible for the disaster were promoted. Timothy Geithner, who oversaw the bailouts, became Treasury Secretary. Lawrence Summers, a longtime advocate of deregulation, became the chief economic advisor. Today, the banks are bigger, more powerful, and more concentrated than ever before. The revolving door between Wall Street and Washington never stopped spinning. Because this isn't a bug in the system. Laws like Dodd-Frank were passed, but many critics saw them as too little, too late, more patchwork than reform. In the end, one truth remains clear. The people who caused the crisis got richer. And the people who paid for it were the rest of us. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies, all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.